What's up, everyone? Major Tom here. We're doing a bunch of videos today on options and basically like what they are, how they work, and just expanding into options because I hear a lot of viewers are like curious on how options work. So I decided to do a couple videos on them because it is like kind of a complex subject. I'm going to try to like get it as beginner level as possible so that you're able to use options by the end of watching like all two or three of these, depending on how many videos I have to make. But I'd like to start off by saying welcome to the studio. The room is kind of messy, but normally I make my bed, but my furry child decided to sleep in today. Um, all right, so we'll just start off with like what is an option, right? There's two types. There's calls and puts. And a call is basically a bullish bet. It's betting that the stock price is going to go up, whereas a put is betting that the stock price is going to go down. And to simplify things, we're going to say that a call is the ability, like you're buying a contract that gives you the ability to buy 100 shares at strike price X. And as you can see, the strike prices, when you're looking through a brokerage app, would be like right here. This is the strike prices. So you're basically betting that the stock is going to hit that strike price before the expiration. That's basically like kind of how you make money, but like super simplified because on very volatile stocks the premium is higher. So like for example on metamaterials, it's pretty volatile right now. It just jumped like a huge percentage in like the last 2 or 3 days. So as you can tell, the break-even price is like $6.13. So it's not enough for you to own this $5 contract and for the stock price to go above $5 for you to make money. You actually don't start making money until the stock hits $6.13. And then anything over that's when you start making money. So that's why I would really want to go into like how calls work, because they're pretty complicated, but there's websites and other brokerages that kind of like really make it easy to trade these. So basically, if you buy a strike price right here, right? The strike price allows you to, like I said, buy 100 shares of stock at that price. So if you were to exercise your contract, like let's say I wanted to own 100 shares of metamaterials, right? And my contract expired on October 15th. I had these $4 calls. They're in the money, right? Because the share price is $4.34 and I'm below it. So all of these are in the money. Now, that means that anytime prior to October 15th, I could theoretically, if I wanted to, exercise this contract. Now, what does exercising a contract mean? It means that, the option itself gives me the ability to buy 100 shares of the stock at that strike price. So if I wanted to own 100 shares of metamaterials and I owned this contract, all I'd have to do is make sure I had $400 in my brokerage account, because that's the strike price times 100. And I could basically absorb this options contract, like it disappears. And then for $400, I'd be able to own 100 shares of metamaterials at a price that's cheaper than the current share price on the market. So that like super oversimplifies things, but basically if I didn't want to exercise this contract at all, right? Then in order for me to make money on this contract, this $4 strike price contract right here, the stock would have to hit $5.33 if I bought it right now. Now, the percent change for the share price to hit that number is this number right here, 22.81%. These two numbers are the most important like numbers for options that I think you could ever use. And the Greeks are important too, like they factor into the premiums and everything like that, but Greeks are like super complicated, and we're not going to go into like the variables on how premiums are determined and stuff like that. That's just too much. So again, if you're using a brokerage app like Robinhood and your brokerage breaks this down for you, that's awesome. A lot of apps don't. Like I use TD Ameritrade for my big money funds, and they don't break this down. So this is really nice to have. I'll show you like basically what to do if your brokerage doesn't do this for you. But basically this is how you do it. We'll look at puts real quick because the puts are a little bit different. So as you notice, like the break even for the puts, the only difference is that it's negative, right? Because a put is like a bearish bet. You're betting that the stock is going to go down. So in order for you to make money on this $4 put right here, the stock basically needs to fall like 28%, right, in order for you to start making money. So like you make money the second it goes like 29% down. So that's pretty important to know. Um, the break even price right here, $3.10. So like the current price is $4.33. So in order for you to make money with this out of the money puts are basically the reverse of a call. So anything above the share price is actually in the money. Anything below the share price is out of the money. Okay. So that's important to know for puts. Now, what to do if your brokerage doesn't have this? So we were just looking at metamaterials, right? So we'll look at metamaterials. This website's called Options Profit Calculator. It's completely free. You can use this. This is what I used when I was like trading options on TD Ameritrade for a while, and then I realized how easy it is on Robinhood, and I was like, oh man, I don't need to use some third-party app. Anyways, let's look at the calls for $4, right? So I don't know if you saw that. Over here is basically where you choose your option. I wanted the $4 strike price. This is kind of like in the middle of the bid-ask spread. On Robinhood, it just shows you the ask, which is fine. Okay, I agree using the terms and conditions. And then down here, you kind of like put a theoretical price of where you think the stock's going to go. So let's say I think, the stock's going to go somewhere between $4 and let's say $8. And again, this isn't my opinion. I'm just showing you how to use this site. Hit calculate, and then basically it gives you this big chart. All right, what to do from this chart. So as you can see, anything down here, you're losing money, right? Anything up here, you're gaining money. So it also tells you your entry cost right here, $130, your break even at the date of expiration. So if you waited and held this contract all the way until October 15th, your break even price of the stock is $5.30. So at that price is when you get your $130 back. That's when your option's worth $130 at the expiration date. So if I wanted to calculate profits, let's say, and this site is still good for like Robinhood users and like other brokerages that show you like, what your break even is. This is still good for those because it can kind of give you like the theoretical, oh, I can make this much money if the stock goes to this. So that's always like really helpful too. Let's just say that my entry cost was $130 for this call contract, right? And I just wanted to, see what I would make if metamaterials went to $8 a share. I would make $281 off of my $130 contract. So that's kind of how this site works. I mean, if you wanted to view any other price, like let's say it goes $7.20, this is how much you would make. And the spread is basically by date. So you just you have your price on the left side, and then at the top you have the date at which it hits that number. And as you can tell, because of time decay, like that percent gain just continuously decreases all the way until expiration. So as you know, like options with time decay in price because that premium, that ability to buy like shares at a specified price is less and less viable as you get closer and closer to that expiration date. For example, like if you were holding a $5 call on metamaterials and for an entire month metamaterials traded sideways at $4.42, which is what it's at right now, right? So you're holding for a $5 contract and the entire time it's just trading sideways at $4.40. As you get closer to this expiration date, look at how like your contract starts to go negative and negative and negative and negative and negative and then just like falls off a cliff, right? So that's something to keep in mind, that like as you approach and get closer to this expiration date and your contract isn't in the money, like the more and more like value that you lose. And as you can see down here, look at the drop off on this. Now this contract is a $4 call, okay, that we're analyzing right now. Look at the drop off on this $4 call as it approaches expiration. That's huge. So if the stock price hits $4 and it trades sideways, look at how much money you lose. So that's another important thing to keep in mind. Like, it's not enough to just hit your break even, right? The break even's $5.30 for this $4 call. It's not enough for the stock to just hit that break even. You also need to basically hit that break even before the expiration in order to make these gains that you see in this like top half of this chart. So that is probably like the most bare bones like expiration as to like or example of how options work. Now we're gonna go into a couple of strategies as far as like how you can make money off of options. I also wanted to do an options challenge, like basically for a whole week, I'll just trade nothing but options on this small money account and show you like how to make money with them. But this is the first video of the series for today, so let me know in the comments section below if this was helpful as far as helping you understand like what a call and put is. And if there's anything that you have questions on, please put it in the comments below and we'll add that into the next video, answer the questions that the viewers have.